Well, meantime, Blackrock publishing its fall investing outlook with a bold call. The traditional stocks and bonds portfolio relationship has broken down. The investment giant saying it expects AI strength to continue despite high valuations, while recommending clients look at bonds. Joining us now on set is Blackrock Chief Investment and Portfolio Strategist for the Americas, Gargi Chaudhuri. Gargi, it's great to have you back. Welcome.
It's great to be here. Thank you for having me.
Let's start right there with that bold call, because you talk about the fact that it's a different regime today and you don't see it going anywhere for a while.
Sure, absolutely. So this is something that has been happening since the pandemic, so over the last 5 years or so. One of the things that we're looking at is just the shift in volatility of a traditional 60-40. So if you had the AG and just the S&P 500, very traditional, something that many investors have in a 60-40 weight, what you've had now is similar returns to the 5 years prior to the pandemic, but unfortunately the volatility of that has picked up meaningfully. So a 70% pickup in volatility in that same 60-40 mix, while at the same time, what we're finding is the correlations, so the way in which they move together or not together has shifted quite a bit. So pre-pandemic, stocks and bonds moved in the same direction only about 50% of the time. Now what we're seeing is that stocks and bonds move in the same direction about 70% of the time. That's not actually what people want. What people want is for them to move in opposite directions. That's why you have it in a portfolio, which is really the thesis that we're starting our fall investment directions with. This idea that there are a few structural changes that have taken place. A lot of them are in the very long end of the bond market, which has a much more positive correlation to stocks than it had in the pre-pandemic period.
That's literally where I was going to go to you. I realize you saw some stabilization in the bond market today, but this has been a global phenomenon, this sell-off in bonds across the world. What do you make of it, and where do you position yourself in light of it?
Absolutely. So to your point, more recently, this has been a global phenomenon. But if we don't look at just the last month or so, but if we think back to even the last year, what we've seen is the long bond or anything that's greater than maybe the 7-year part of the curve has not had that traditional negative correlation to stocks as the pre-pandemic period. So you haven't had much reward for the risk that you are taking holding treasuries or credit for a longer period of time than if you just held it in the front end of what we call the belly of the curve. So we still think bonds are extremely attractive. You know, we're telling investors to go to something like the Blackrock Income Fund, which is an actively managed ETF that is offering you about 6% yield with not a lot of duration risk. So we do think fixed income makes a tremendous amount of sense, but where you source your duration from and where you source your yield from is really important.
But why this time? I mean, investors who thought 3 or so years ago, oh, well, there's a very good value there, I should buy it now. Now it's extremely good, right? Because that bet didn't work out. Why is it going to work out this time on bonds? Why can you buy them and not expect them to? Yeah.
Right. So a few things. The first is buying them in the belly of the curve and recognizing the yield availability, whether you own treasuries or whether you own corporate credit, whether you own securitized credit or a multi-sector portfolio of core plus bonds, which has all of these. When you buy that, you're harnessing much higher yield than you could 3 years ago. So the starting point is really attractive. The second point is just the cycle that we're about to get into. So the Fed most likely is going to cut rates later this month. And again, they might cut, we think, again in December. So this idea that you're not going to have as much in a cash or a cash-like holding will actually, we think, enable a lot of people to step out. They're not going all the way to equities, but where we think they'll step out into is these traditional sources of income that you didn't have 3 years ago, 5 years ago.